Hey guys, it's Rich with Spokane Home Guy Group and One Property Network. And this month for our November newsletter and market recap, I'm joined by Todd Fenninger. Yes. You always have to correct me a little bit, so I just got to get some humor in there. I mispronounce everybody's last name on purpose. With Catalyst Lending Team, so Todd Fenninger with Catalyst Lending Team. And we're going to go over real estate recap for the month of November 2023, as well as mortgage recap. And people should be excited to hear about like a rate recap and on the mortgage side, I would think, for the month of November. So just kick off by looking at the month of November from a real estate perspective. What you guys care about the most is what happened to the price of my home. And so for the month of November, we actually saw positive price appreciation in the median sale price and the average sale price. Up a little over 2% pretty much across the board. And that puts us year over year, if we look at November of 2022 to November of 2023, with a positive 3%, a little over 3% gain in the median sale price, across markets that we operate in. The days on market is still holding pretty strong as far as sellers are concerned, at an average of 19 to 25 days on market, depending on which market you're in. So still taking less than a month to basically, if we had no new homes come onto the market, 100% of the inventory would sell. 100% of the inventory would sell within a couple of months, but the average days on market for the homes that enter the market is still under a month. So still selling relatively quick versus historical. And we saw some positive gains in price over the last month and year over year. So, and we'll talk more about that as we go along. We'll have kind of a 2023 recap, as well as talk about 2024. But let's talk about rates, like something to be excited about this month.
Yes, absolutely. So rates peaked at the highest we've seen in the month of November. FHA rates average, according to the Mortgage Bankers Association, was 7.31. And that's now lowered down to about 6.98. The big change was on the conventional side, where rates actually peaked over 8% for a few days at 8.04%. And we're now down at about 7.17%. So almost 1% lower. That's a huge change. We've been waiting for that to happen. Mortgage rates are driven by investment into mortgage-backed securities. And so, today the FMOC is meeting, the Fed, as people call it, are meeting to talk about whether they'll raise or lower the Fed fund rate. The Fed fund rate, of course, does not directly influence mortgage rates, but there is a correlation there, and we will be anxious to see, what the result is. The expectation is that they'll probably hold steady. Mm-hmm. They don't get too excited over lower inflation data, although that's what they want to see is consistently lower inflation data. And right now we're sitting at sub 1% inflation numbers. Our year over year numbers are looking really good, and that's what they want to see. So we are anticipating this drop in rates that we've seen to hopefully be the start of something good, and we may see some lower rates moving forward.
Yeah, and I'd say, like, if there's no way to really time the market as far as what rates are going to do, what housing prices are going to do, but if we look at 2023 in general, on the real estate side of things, we've had consistent low inventory, 30-40% below what we've had over last year. And that's not just a 1 year thing. Like, that's kind of been a trend over the last couple of years. On the rate side, we saw a spike up to 8%, which kind of, I'd say that stalled things or gave people pause more so than even during the pandemic.
Yeah, I think so. And also, the timing of that 8% rate, in November moving into winter, I think really did slow things down a little bit.
Yeah.
But as we move into spring is typically a very active market. I mean, there's a lot of people that start thinking about buying once the holidays are over. And I mean, with rates coming down a little bit, I would anticipate there to be a lot more activity in the spring.
Yeah, I do too. And I for people that are trying to make a decision around like real estate prices going down or tanking or a bubble or whatever it may be, like if we look at just simple supply and demand, if inventory has been declining over the last couple of years and rates have increased, you'd expect prices to come down. And what we discussed at the beginning of the video is that like prices are actually, I mean, real estate has been really resilient. And as a matter of fact, like if you just look at inflation data, and if you're of the opinion that inflation is not going to drastically decline, there's no better asset to own. And for those of us living in a house, making memories and all that stuff, like we don't look at it as an asset. But if you're talking about just a simple decision of can I own, should I make the decision of owning real estate? There's no better inflation hedge.
Absolutely.
Yeah.
I mean, the long-term average for real estate is what, 4.8%, something like that.
If you look back, if you look back since like World War II, it's averaged 4 or 5%. But if we look back, January of 2016, right? The median price, and this is just for the Spokane market, I'm using that data in this particular example to show that like time in real estate versus timing the market is really like where you're going to earn your equity. So the median sale price in January of 2016 was $179,750. So in 7 years, right around 7-8 years, that is more than doubled. So our median sale price in November, as of November 2023, was $419,406. That's median. So just the middle number between the lowest price of sale and the highest price of sale was $419,406. So all you had to do was maintain a property, eat, sleep, and unlock a door. And
one thing I think a lot of people forget, I mean, I often hear the comparison to the market. Okay, well, yeah, but the stock market averages, 7 to 10%, sometimes a little bit more. But your starting basis for real estate is the value of the home. So, if you're investing $10,000 to purchase your first home, and that's your starting investment, if you were to put that money into the market, your appreciation is starting off of that $10,000, whereas with a home, your appreciation is starting at $300,000 or whatever that entry point is.
Oh, exactly. Like
so even though that appreciation number is a little bit less than like the stock market, when you look at it over a 15-year spread, the amount of equity that you gain and the amount of money that you make is far greater than you would by putting 10 grand into the market.
Yeah. And if you look at just interest rates, which affects affordability for sure. If you made a decision to buy in 2016 and you put 10% down, that's $18,000. So that $18,000 turned into $200,000+. In 2016, correct me if I'm wrong, but I think rates were they're probably a little bit lower, so that's probably a bad example. But
they were a little bit lower, but not dramatically. I mean, I think just going off of memory, I would say that they were 5% range.
Yeah. So in talking about history and time in the market versus timing the market, in 2024 we have an election coming up, so I wanted to kind of like just recap, or not really recap, but end our monthly newsletter with just a little bit of a history lesson on real estate. And that is, if you look back, I pulled up a chart because I was curious. And we hear it a lot of like, I'm not going to do anything until the election's over and I know who won. And so I was curious, like, how that affected real estate prices, right? So I went back to 1990. So right around 1990, we had the Gulf War. Shortly after that, in 92, we had a Democrat that won the election. That was Clinton, I believe. And so between the Gulf War and that election, real estate went up. So then between 1992 and 1996, we had another Democrat. Real estate went up. Between 96 and 2000, in the year 2000, we had Y2K. We had a Republican that took office in 2000. Real estate went up. 2004, and in between 2000 and 2004, we obviously had 9/11. But 2004, so that 4-year period, real estate went up.
Kind of sounds like you're saying real estate always goes up.
Well, I mean, so if we look here, like in 1990, this is nationally, but like we were right around $100,000. By the end of 2000, so we had a war, we had Y2K, which everyone thought the world was coming to an end, and we had 3 presidential elections, and we ended up gaining roughly $50,000 in equity. So 50% return on real estate during that period of time. So then between 2000, 9/11, another Republican elected in 2004, we saw real estate go from roughly 150 to almost 200,000 average sale price. Then obviously we had 2005, 2007, which is the only real estate related like recession or crash. And if you look over those 2 years, peak to peak, it was flat. Mm-hmm. So between 2005 and we'll say 2008, that was flat. Now, 2009 is where we saw a lot of the damage. And then, by the way, in 2008, we had a Democrat that was elected. And so between 2008, where we really saw the ball rolling with like the mortgage related, real estate related, whatever. So between 2008 and 2012, like wasn't a good 4-year span for real estate. But that's the only time in history that we've seen like a real estate related crash.
Yeah,
right.
Absolutely. And it was the longest span. I mean, usually any dips in value have been maybe 1 year. That was the longest span because it was real estate related.
Mm-hmm. Yep. So if we go from 2012, 2016, Republican elected, 2020, Democrat elected. In between there, we had a pandemic. We had interest rates that doubled at some point in time over the last couple of years. We had the Ukrainian war. What else do we have? We have Israel and Gaza going on right now. And yet, between 2012 and today, we went from roughly 160, 170 average sale price to up to over 400,000.
Wow. Yeah. So basically what you're saying is it doesn't matter. People don't make their home buying decisions based on who's president. They don't decide whether to move or own a home or whether to invest in their family based on politics.
Yeah, I mean, like you're gonna buy a home based off of a life event or a need or things along those lines. Like I think that, buying or selling a home based on the amount of equity that you gain in a year or 5 years or whatever, like that's gonna slow. So the excitement around the velocity of the market of like, I bought a house and now it's worth $100,000 or $200,000 the next year, like that's gonna slow down a bit. And if you look at a home over a longer period of time, like all of the noise that happens in between like your purchase or your decision and your purchase, like it doesn't matter.
Right.
It honestly doesn't matter.
Yeah. I mean, when we bought our first house, we weren't thinking about who was president. We weren't thinking about politics. We were thinking about, we want a house where we can raise a family. We want a place to call our own, and yeah, I think for the majority of people, that's the case, right? You buy your home because you want to own, you want to have a place that's yours. And I mean, there is that side benefit of the fact that the vast majority of the time that home is going to go up in value. It will go up in value as long as you hold on to it for long enough, even if there was a small change in value to the negative, that's usually erased by the following year, and then it keeps going up in value. So.
Yeah. Well, and I mean, which could be college, which could be, trade up or trade down. It could be part of your retirement fund. I mean, there's so much you can do with the equity in the house, and it's not really the point of the conversation. But just in recap for 2024, like I do think rates are going to continue to go down. And I think if you look from January to December, I wouldn't be surprised if we saw 5 in front of the rates, but it might be like 5.9 or something like that.
Yeah, I think most analysts are thinking the same thing. Granted, when rates are always moving up and down, right? It's not a straight line, and so there will still be weeks or months where rates go up, but on a long-term trend, we should see rates coming down in 2024.
Yeah. Yep. Yeah. I think we might see a little more inventory come onto the market. I still think we'll see price stability, appreciation in that 3 to 5% range. And
what do you think is going to happen if, let's say rates do come down to 5.9, like you said? What will that do to home prices in Spokane?
It's an inventory question, really. Like we don't have a rate problem; we have an inventory problem, and so it's going to largely depend on are people sitting on the sidelines waiting to make a decision until you get to 5 or 6% interest rates. If so, we could see a lot of inventory come onto the market, and if that's the case, then I think prices are gonna go up as rates go down, and I don't think we'll see a ton of like an exponential amount of inventory come onto the market. Like I don't believe we're going to see a 40 or 50% increase in inventory on a relatively short period of time. So yeah. If somebody is making a decision to purchase a home and they do need financing, how can they get a hold of you?
Yeah, they can reach me on my phone at 509-944-6206. You can also follow me on Instagram at lendertodd.
Awesome. And as always, SpokaneHomeguy.com, ColumbiaBasinHomes.com, or One Property Network, and any one of our lovely agents are happy to help.